September 16, 1992. This day will forever be remembered in the currency markets as Black Wednesday, one of the most catastrophic financial events in history. On this day, the British pound collapsed and forced the British government to withdraw the pound sterling from the European exchange rate mechanism. While the ramifications of this hurt the economy for years, one of the speculators behind this collapse made one of the greatest currency trades in history on that day. This one trade made over $1 billion in profits. In this video, I'm going to share with you how this trade idea came about, the thought process behind it, and how you can learn from this once-in-a-lifetime trade. Hey traders, this is Mike Sir here. I've been an active trader for over 21 years and a trader coach for the past 15 years. In my videos, I profile all the top traders in the world and teach you how to replicate their incredible success. I've been fortunate to train many successful traders, and in this video, I'm going to talk about a trader who became a trading legend after profiting from the greatest trade in currency market history. His name is George Soros. George Soros is a Hungarian-born American billionaire investor with a net worth of over $8.6 billion. He manages one of the most successful hedge funds in history called the Quantum Fund, which started with only $12 million in assets under management in 1970 and grew it over to $25 billion by 2011. In July 2011, Soros returned all the funds from outside investors' money, valued at over $1 billion, and instead invested funds from his own $24.5 billion family fortune due to changes in U.S. Securities and Exchange Commission disclosure rules. The fund had at that time been averaging over 20% per year compounded, and some years posting returns of over 100%. In 2013, the Quantum Fund made $5.5 billion, making it again the most successful hedge fund in history. Since its inception in 1973, the fund has generated over $40 billion in profits. Now, Soros is known to have an aggressive trading style and has a keen eye for betting against overvalued currencies, and some of it is due to his early studies of philosophy. This is when he formulated the general theory of reflexivity for the capital markets, which he says gives him a clear picture of asset bubbles and the fundamental and market value of securities and currencies. Now, for those who wish to learn more about Soros' theory of reflexivity in the financial markets, please comment below and I'll put a video together in the future to show you how you can apply his principles to today's markets. Also, if you wouldn't mind, please take a moment to like this video. I would really appreciate your support. Okay, let's continue with the video. Now, Soros is not just famous for the returns that he generated, but he's most known for the man who broke the Bank of England because of his massive bet of $10 billion against the pound sterling. And this is what I'll focus on next. Before I dive into the trade, let me give you a quick European history background first so you can understand the context of the trade. Now, before the current European Union that we know of today, which has a single currency, which is the euro, there was a formation of what's called the European Exchange Rate Mechanism, ERM, in 1979. Now, countries under this system agreed to fix their exchange rates with each other instead of floating their currencies and letting capital markets determine the rates of exchange. The purpose was to reduce exchange rate variability and stabilize monetary policy across Europe. At the time, Germany had the strongest economy in Europe, so each country set their currency value in Deutschmarks and decided to maintain a fixed exchange rate between their currency and the Deutschmark within an acceptable range of plus or minus 6% of the agreed upon rate. Now, with currencies fluctuating daily due to trade, European central bankers had to monitor the currency closely to ensure that the rates remained within the acceptable band, and sometimes required them to participate in the market and stimulate it in certain directions. Let me share with you two ways how central bankers can influence their own currency. First, they can take their reserves of foreign currency and buy their own currency on the open market. the buying would cause their currency to appreciate relative to other currencies. Or another way for banks to adjust exchange rates is by increasing or lowering interest rates. Raising interest rates would encourage a flow of capital into the country due to higher yields and as a result cause the currency to appreciate. In 1990, Britain finally decided to join the ERM and fixed their exchange rate at 2.95 Deutschmarks for each British pound, and were required to keep the exchange rate within 2.78 Deutschmarks to 3.13 Deutschmarks. Many people at the time commented that the fixed exchange rate was set way too high, given that the economy was riddled with high unemployment, low productivity, and an uncompetitive export market, and not surprisingly, by the spring of 1992, just a year and a half after Britain joined the ERM, the fixed exchange rate was showing signs of cracking. At the time, the British pound was trading at the lower end of the agreed-upon band with the Deutschmark, and everyone, including British government, knew it was trading at an unsustainable level. Now, what kept the pound from falling in value was the British government's guarantee that it would keep buying pounds to keep the value propped up, and the market believing that it would. As long as the status quo was maintained, then everything would remain stable. However, behind the scenes, something was happening that would cause drastic consequences for the British pound. The market got a hint of this after a Wall Street Journal interview with then President of the Bundesbank, which is the central bank of the Federal Republic of Germany. He revealed that there will be a realignment of currency values within Europe's exchange rate mechanism, and that the pound sterling was one of those currencies that could come under pressure and be devalued since it was trading at levels that were far away from its inherent value. Now, this interview will be the nail in the coffin for the British pound and prompted this response from George Soros.
The Bundesbank was basically egging on the speculators to speculate against the weaker currencies. And we took our cue, actually, from the Bundesbank.
Everything would change the following morning. Over the past month, Soros and his team had already been building a $1.5 billion short position, anticipating that an overvalued pound would be compelled by the market to drop down to its equilibrium price, devoid of any artificial intervention. So let me outline what Soros was thinking at that point. So at that time, the pound was trading at the lower end of the agreed level. The market was now convinced that the pound was overpriced due to comments from the president of the Bundesbank. The currency required support from the Bank of England just to remain at its current level, and if it stopped buying, then the price could collapse. The possibility of the pound rising up to its upper range was virtually impossible, and even if it did, it would just be temporary. But if the value of the pound dropped, Soros could potentially make billions on his short position, and this was when he took massive action. On the morning of Wednesday, September 16, 1992, Soros dramatically increased his short position against the British pound from $1.5 billion to $10 billion. How he built such a massive position against the pound was the same strategy that Andrew Krieger used to build against the Kiwi, and was also through buying put option contracts. Now, for those who are interested in my video on outlining the strategy that Andrew Krieger used to make $300 million in profits, I have attached a link below in the description. Now, other hedge funds started hearing about what Soros and his team were doing, and they decided to join the trade and short the pound as well. Now, this led to tens of billions of pounds being sold by the time the London markets opened, and pushed the currency dangerously close to below the levels mandated by the ERM. Now, in response, British officials tried to prop up the pound by depleting its reserves of foreign currency to no avail. So for example, soon after the market opened, they put in 2 orders of 300 million pounds each to buy the pound, but only to see Soros' fund dumping pounds at a faster rate than the Bank of England could buy them. The Bank of England carried on intervening, not realizing how completely it was outgunned. By 8:40 a.m. that day, it had purchased a total of £1 billion to prop up the pound, but prices barely moved up. With an act of desperation and no other option, the British government tried to drive up interest rates to prevent the pound from free falling and scare off the speculators. At around noon local time, they announced an increase in interest rates of 200 basis points, basically increasing the interest rates from 10% to 12%. This had no effect as the pound continued to fall in value. In fact, this signaled to the market the opposite effect, and this is what Soros had to say about that.
It indicated to us that we are in at the end game, that there was no, this was an act of desperation. So instead of restraining us, it was really an invitation to double up, to try to sell as much more as possible.
Investors all around the world were now convinced that the currency would continue to fall, and it made a bad situation even worse. In fact, the British government would later try to raise interest rates yet again to 300 basis points and push interest rates from 12% to 15%. Again, this announcement had no effect on the pound's value, and this would lead to one last push to sell the life of the British currency for speculators like George Soros. Finally, later that evening, Norman Lamont, Chief Secretary to the Treasury, called a press conference in the Treasury's central courtyard.
Today has been an extremely difficult and turbulent day. Massive speculative flows continue to disrupt the functioning exchange rate mechanism. As chairman of the Council of European Finance Ministers, I have called a meeting of the Monetary Committee in Brussels urgently tonight to consider how stability can be restored to the foreign exchange markets. In the meantime, the government has concluded that Britain's best interests are served by suspending our membership of the exchange rate mechanism. As a result, the second of the two interest rate increases that I sanctioned today will not take place tomorrow, and minimum lending rate will be at 12% until conditions become calmer.
Britain would leave the ERM and float its currency on the open market, marking a decisive victory for current speculators like George Soros. The British government would end up spending $3.3 billion of taxpayers' money to prop up the pound without anything to show for it. So let's take a look at the chart of the pound versus the Deutschmark and summarize the trade that Soros and his team made. So George basically started building positions against the pound in August around the 2.8 to 2.84 price levels. And you can see here 2.78 was the lowest end of the fixed exchange rate that Britain had to maintain. And you can see right here how much support was being exhausted to support this price level. And you can see here where they announced interest rate hikes and the price barely moved up. Then you can see that it fell back down, and finally when Britain announced that it was getting out of the ERM, the British pound plunged as much as 15% in a matter of a few weeks. And here you can assume that George exited his short positions around the 2.4 to 2.5 price level. So here's how much George said that he made on that trade.
In excess of $1 billion of profits, because we had a position approaching, I think, $10 billion, and the fall was more than 10%.
In the years following after 1992, Soros and his team continued to make big currency profits betting against the Thai baht in early 1997 before the Asian financial crisis, as well as between 2013 and 2014, shorting the Japanese yen while betting on Japanese stocks for another $1 billion in profits. Now these trades basically cemented George Soros as the most successful currency trader in the world. Here are some lessons that you can learn from George Soros that you can apply to your own trading. So the first lesson is go for the kill. When George's chief portfolio manager Stan Druckenmiller walked into George's office the day before Black Wednesday, they'd been holding a $1.5 billion bet against the pound for about a month. Now, Stan was advising George that they should keep building on the position steadily. So George listened and he looked puzzled. He said, "That doesn't make sense. If the president of the Bundesbank, if his quotes were accurate, he said, why just build steadily? He said, go for the jugular." Now, Stan had done extensive research and analysis of the trade. He understood the politics and he saw the trigger for the trade, but George Soros was the one who sensed that this was the moment to go all in. And this is one of the reasons how George separated himself from other successful traders. So when you know you are right, there's no reason why you shouldn't trade aggressively and with big size. You basically try to build as big of a position as you possibly can. The second lesson that you want to learn from George Soros is look for weakness. When the British Central Bank announced that they were raising interest rates, they were hoping that it would provide strength to the British pound. But when such a strong catalyst like an interest rate hike is unable to boost a currency's value, then it's telling you that there is weakness. So therefore, rather than buy the currency, you should look for opportunities to short or bet on the downside. And it's the same when you sense strength. The third lesson is prepare for the unthinkable. So in 1992, the thought of Britain leaving the ERM was unthinkable to many during the crisis. Well, let me remind you of what happened not too long ago. On June 23, 2016, the event known as BREXIT was when the UK held a referendum on whether to leave the European Union, and 52% of the voters voted to leave. And this at that time was also unthinkable. Thanks for watching. If you like this video and want to watch other videos where I profile the top traders in the world, please go to my playlist under Top Trader Profiles. Also, if you wouldn't mind, please smash the like button for the YouTube algorithm, hit the subscribe button to watch more videos like this, and hit the notification button so you'll be notified of future videos where I profile the best traders.